Bridging loans might seem appealing, but there are a range of factors and risks that most people don't consider that usually end up landing them in hot water, especially when it's far too late to change course. So in this video, I'm going to share with you everything you need to know about bridging loans, what they are, when to use them, how to access them, and what the risks and considerations are. Hi everyone, Tommy Lim here from SF Capital. Now you've probably heard the term bridging loan thrown around, so I think it's important to firstly define what one is. A bridging loan is a type of loan offered by a bank because of a timing difference between the property you are buying and the property you are selling. Under a bridging loan, a bank temporarily lends you more money than you can normally afford so that you can settle on your next home while you wait for your current home to be sold. Now, while a bridging loan might seem appealing by allowing you to purchase the property that you want sooner, banks place strict criteria on who is eligible, and the risks of taking on a bridging loan are not for everyone. So, this leads to the question of when is a bridging loan needed? To answer this question, it's best to consider a simple diagram and look at scenarios for when a bridging loan is and isn't needed. From this diagram, the importance of timing also becomes apparent. The first scenario is a simultaneous settlement. This is where you're able to perfectly line up the two settlement dates of the properties you're buying and selling so that there is no timing gap. The funds from the sale of your old home are immediately applied to your next home on the same day. Simultaneous settlements, however, can be risky. There is the possibility that the buyer of your old home is not ready with the money, holding you up for your own purchase. This is known as counterparty risk. The second scenario is a prior settlement. This is when you settle on the sale of your current home first. This is the least risky approach to buying and selling, as it guarantees you have the funds to complete up front. However, it raises its own problems. For example, if you've sold your home and have not settled on your new place, the question remains, where are you going to live? In practice, we find that clients tackle this problem by moving in with friends and family, trying to rent from the new owner temporarily, and even staying in hotels or Airbnbs for a short period of time, treating it as a holiday. Finally, there is a bridging scenario. Now you can see from the diagram, this is when the settlement dates are flipped. The property you have bought needs to settle first, meaning you need substantial funds today. But these funds are tied up in the equity of your old home, which will not be available to you until this property is sold at a later date. This means you need a large but temporary amount of funds up front, in other words, a financial bridge, to get you through this period until your home is sold and you can pay down the bridging loan to a more manageable level. What are the main criteria for a bridging loan? So, knowing when a bridging loan is required, the next question is under what circumstances will a bank approve a bridging loan? Here are 5 considerations. Number 1, the loan to value ratio must be less than or equal to 80%. This includes the combined LVR when both properties are taken as security. This means when the bank sets up your bridging loan, they take security over both your old and new property. Number 2, you must show that you have sufficient savings to afford the interest payments during the bridging loan, or for some lenders, have enough equity to accrue what is known as capitalized interest. This sometimes makes the maximum LVR on your existing home only 70% at the time of taking out the bridging loan. Number 3, when you sell your old home and close out the bridging loan, you must demonstrate that you can service the leftover loan known as the end debt or residual debt. Number 4, the net proceeds of sale are enough to pay down the bridging loan so that only the agreed end debt remains, after accounting for all interest and selling costs. And finally, number 5, you must sell your old home and close out the bridging loan within a maximum of 12 months, meaning that this can't drag out for more than a year. Now, we also need to factor in the costs of taking out a bridging loan. The most significant cost is basically the interest incurred while the loan is open. This can be a substantial amount because you're temporarily taking on more debt than you can normally service. And the longer you have the bridging loan in place, the more interest you will pay. There are 2 ways that the interest can be charged depending on the bank that you go with. The first method is on an interest-only basis, where you make a monthly repayment to keep the bridging loan in place based on the discounted variable rate you negotiate. The second method is where interest is capitalized. This means that you don't need to make any monthly repayments. Instead, interest gets added to the loan and is cleared once your old home is sold and settled. While incurring capitalized interest is more convenient, it can be more costly, as the interest costs compound and get charged at an undiscounted variable rate. The other costs to set up a bridging loan include extra valuation fees, transfer, registration, and setup fees, especially if you are refinancing to a new bank to establish a bridging loan, and any advice fees charged by your broker for taking on a more complex scenario. So, is there anything else you should know, or are there any other risks you need to take into account? Like I said at the start, a bridging loan isn't for everybody, and there are many considerations before you decide to use a bridging loan. First, before you exchange contracts for your next home, you need to be confident that the bank can approve your bridging loan. Given the strict criteria, you should check off your eligibility with your broker first by seeking a pre-approval. Secondly, you need to be comfortable with the costs. And if your bank requires you to make monthly interest-only repayments, you need to have a sufficient cash buffer to make the bridging loan repayments for up to 12 months. And finally, you need to be confident that you can sell your property and close the bridging loan on time, especially during tougher market conditions. This includes budgeting enough time to complete any renovations to prepare your property for sale and effectively marketing the property to secure the price you are after. So that's everything we know about bridging loans, and we hope you found this video useful. If you're still not sure if a bridging loan is right for you, please get in touch with one of our brokers so they can help you with a proper assessment. And of course, make sure you share and tag any of your friends who you know that would benefit from this video. Thanks, and see you in another upcoming episode of our next Home Buyers series.